Two tech giants, Salesforce and Meta, both hit by major pullbacks this year. But beneath the volatility, their latest earnings show strong long-term opportunities. In this video, we will cover their financials, why stocks dropped significantly year to date, and whether this is the right moment to enter. Let's dive in. Hey there, I am Palani, a technologist turned investor and an early retiree. I share my experiences from 20 plus years of investing in US and in India. Please note that I am not a financial advisor. This is not a buy or sell recommendation. Do your own research before investing. Without further ado, let's jump right in. First up, Salesforce is down roughly 22% year to date, mainly because investors questioned the pace at which Salesforce AI initiatives, particularly Agentforce, will generate revenue and earnings in future. Agentforce is sort of an AI-driven digital labor which automates sales and customer service workflows. Let us take a peek into Q3 results. In Q3, Salesforce reported a revenue of $10.3 billion, which is 9% increase year over year. The company also raised its full year revenue guidance between $41.45 billion to $41.55 billion, driven by strong performance in its Agentforce and Data 360 products. For example, annualized revenue from Agentforce jumped by massive 330%. Let us now look into valuations. Price to free cash flow at 19.2% is quite low historically, and price to book ratio of 4.15% is an attractive valuation for enterprise software with significant AI opportunities. So, why CRM now? One, Salesforce remains the global CRM leader with sticky recurring enterprise revenue. Number two, its pivot into AI Agentforce plus data cloud positions it for a deeper monetization across sales, service, marketing, and automation. Third, the recent sell-off is sentiment driven, not fundamental driven, giving long-term investors a chance to buy high-quality enterprise software name at a discount. Moving on to next stock in our list, Meta. Meta shares slid sharply after Q3 earnings, not because of business weakness, but due to a massive $15.9 billion one-time tax charge triggered by the new US tax law. This charge sent Meta's effective tax rate to 87%. Yes, 87%, crushing reported earnings. Investors obviously reacted strongly, pushing the stock down 7 to 9%, even though Meta exceeded in earnings excluding one-time tax provision. This pullback offers an opportunity to buy a solid business at a reasonable price. Now, let's look into Q3 numbers. Revenue, $51.24 billion, up 26% year over year. Daily active users up by 8% to 3.54 billion. The Meta also guided Q4 revenue to 56 to 59 billion, signaling confidence in the demand, particularly the ad demand. So, why Meta looks so attractive now? One, Meta's core business, ad plus engagement across Facebook, Instagram, WhatsApp remain extremely strong. Second, AI-driven recommendations, Reels monetization, and messaging-based commerce continues to grow. 3. Heavy AI investments, including data centers, compute ecosystem, should fuel long-term ad efficiency and new revenue streams. So, what are two key risks for the business? One, extremely high capex spend, AI plus infrastructure build out. This could pressure near-term free cash flow. Two, regulatory pressures, particularly privacy, antitrust, and international laws, remain persistent external risks. Now, in nutshell, Salesforce and Meta both faced sharp pullbacks, but for very different reasons. Salesforce is dealing with sentiment around enterprise AI adoption, while Meta took a temporary accounting hit. In both cases, the underlying business remains strong and long-term growth potential looks compelling. If you found this analysis helpful, hit like and subscribe. Thanks for checking in and see you in the next video.